Jamie Dimon went on camera, named Coinbase's CEO by name, and said the banks will fight the Clarity Act. The Senate Banking Committee passed it anyway, 15-9. And buried inside the banking lobby's own objections is a 20% figure that tells you exactly what this fight is really about, and it has nothing to do with consumer protection. Had you already heard that JP Morgan was publicly opposing this bill while quietly building products on Coinbase's infrastructure? Drop a yes or no in the comments right now. This is not financial advice. This is for educational and informational purposes only. Do your own research before making any financial decisions. If this kind of coverage is useful to you, hit the like button. It helps this channel reach more people who need to see it. Now, let me walk you through exactly what happened and what it means for the thesis you have been holding. The Clarity Act is the first comprehensive legal framework for digital assets ever written in the United States. Before it, regulating crypto in America happened through enforcement. The SEC would sue a company. A court would issue a ruling. Developers made their best guesses about which rules applied to them, knowing that a wrong guess might mean a lawsuit years later. The Clarity Act replaces that with a law. What it does in concrete terms is divide the oversight of digital assets between two existing federal regulators. Assets that function like investments in a company are classified as securities and fall under the SEC. Assets that function more like currencies or raw materials are classified as commodities and fall under the CFTC. Before this bill, that line did not exist clearly in law. Developers could not look at their product and know with confidence which regulator applied. The Clarity Act draws that line. For the first time, someone building a blockchain application in the United States can know what the rules are before they launch, not after they receive a lawsuit. This comes at a moment when one part of the regulatory picture is already settled. The Genius Act, a separate bill focused on stablecoin payments, passed Congress last year. That legislation established the foundation for how stablecoins are governed in the United States. The Clarity Act is the next chapter. Developers who have been waiting to build applications that use crypto technology to transfer value in different forms have been watching for this framework to arrive. The Genius Act told them stablecoins were being addressed. The Clarity Act is designed to address everything else. The bill reached this point through a process that began in the House. It passed there in July of last year with a vote of 294 to 134. In a chamber where bipartisan agreement is rare, that margin is meaningful. It then moved to the Senate, where it stalled and where it still sits today, advancing but more slowly than its supporters expected. The reason for the slowdown was a single provision, the treatment of stablecoins and the yield they can offer. A stablecoin is a digital currency designed to hold a fixed value, typically tied to the US dollar. When you hold one on a crypto exchange, you can, depending on the platform, earn a return on that holding. That return is called yield. The yield available on stablecoins held on crypto platforms has historically been significantly more competitive than what a traditional savings account at a bank pays. The banks noticed, and they organized. Their position was specific. If crypto platforms can offer competitive yield on stablecoins, depositors will move money out of savings accounts and onto those platforms. They put a number on that risk. Deposits available for consumer loans could drop by as much as 20%. JP Morgan Chase, the American Bankers Association, smaller community banks, and credit unions all aligned behind this position. Their shared goal was to strip the yield provision from the bill entirely. The negotiation that followed stretched across months. One participant described it as sucking all the oxygen out of the broader legislative process. The compromise that emerged drew a specific line. Crypto platforms cannot offer passive yield, a flat return simply for holding a stablecoin. What they can offer are rewards tied to real activity, completing transactions, participating in a network, actively using the platform. The banks rejected even that and pledged to increase their opposition. Senator Cynthia Lummis spoke plainly about the bank's motivation. She said directly that JP Morgan Chase and other large banks are fighting the Clarity Act because they are scared, not because the bill is poorly written, because it introduces competition they would prefer not to face. She argued the banking industry should embrace digital assets rather than fight them, and that the fight is ultimately futile because digital assets are going to be part of the financial landscape, regardless of what any institution wants. The Senate Banking Committee voted 15-9 to advance the bill on May 14th. All 13 Republicans on the committee voted yes. 2 Democrats voted with them. The bill now moves to the full Senate floor where it needs 60 votes to advance. That threshold is the next and most significant obstacle. It requires meaningful Democratic cooperation in a chamber that does not provide it easily. Because once you understand that the same bank publicly fighting this bill launched its own crypto product on Coinbase's blockchain the month before, you stop seeing this as a policy debate. You start seeing it as a commercial negotiation being conducted through legislative opposition. The banking lobby's 20% figure is the detail in this story that deserves the most examination, because it is not an argument against the Clarity Act. It is an admission about the state of traditional banking. When a lobbying organization publishes a number claiming that a proposed law would move 20% of bank deposits elsewhere, that number is not invented for political effect. Lobbying organizations use the most defensible figures they can support. They do not overstate risks in their own internal analysis. Overstating creates credibility problems when their claims are scrutinized by committee staff. So when the banking lobby says 20%, they mean something close to 20%, and that number says something precise. If given a legal, regulated, compliant way to earn a better return on their savings, $1 in $5 currently sitting in traditional bank accounts would move. That is not a niche adoption figure. That is a statement about how many ordinary depositors currently feel underserved. Picture someone who spent a career building savings, setting money aside every paycheck, watching it accumulate until it represented real security, real options, real peace of mind for the years ahead. That money is sitting in a savings account today. The bank holding those savings is simultaneously lobbying against a law that would give that depositor a legal pathway to earn a meaningfully better return, because a better return elsewhere means fewer deposits remaining inside the bank. The bank is not protecting that depositor's interests in this fight. It is protecting its own revenue model at that depositor's expense. That is the honest reading of the 20% figure. The banks calculated it themselves. This is why Jamie Dimon chose to go on camera and make the fight explicit. His stated objections were specific. The Clarity Act allows crypto platforms to effectively pay interest on deposits without the legal protections he believes should apply. He raised concerns about how financial institutions track and report transactions to prevent money laundering. He named Brian Armstrong, Coinbase's CEO, by name. He said directly, "The banks will fight this." And then he said, "If we lose, and we will live." The American Bankers Association stood alongside him, small community banks alongside him, credit unions alongside him, a broad industry coalition, not a complaint from one large institution. And yet the picture becomes far more complicated the moment you look beyond the public statements. But this is the part almost nobody is sitting with. In November of last year, JP Morgan Chase launched its own deposit token, a digital dollar equivalent product on Base. Base is the blockchain network built and operated by Coinbase. JP Morgan is building its digital financial infrastructure on the same platform operated by the company whose CEO it publicly challenged. In July of last year, the same month the Clarity Act passed the House with 294 votes, JP Morgan Chase and Coinbase announced a strategic partnership specifically designed to make it easier for consumers to purchase crypto. The chief product officer of Coinbase then stated publicly that the Clarity Act is very close to getting done and added something specific. JP Morgan wants to get into the crypto space, not that JP Morgan is being dragged in reluctantly, that they want to enter. There is another dimension to this that almost never gets discussed. The Clarity Act is the first piece of legislation since 1992 that would give banks new legal authorization to enter the crypto space. The bill does not only create a framework for platforms like Coinbase, it creates a legal on-ramp for every major traditional bank to offer digital asset products to their customers. The institution fighting hardest against this bill is also positioned to benefit most directly from the legal clarity it would provide. Two parties publicly at war, building on the same infrastructure, partnered in the same market, both, by the account of one of them, wanting the same law to pass, just on different terms. Now, here is where things get serious for what this fight actually means. The conclusion that follows is not complicated. The fight is not over whether banks enter the crypto market. They are already entering. The fight is over the specific regulatory terms, over whether bank-affiliated digital products and non-bank platforms like Coinbase face the same rules. It is a commercial negotiation being conducted through legislative opposition. The thread that remains open, the one with no resolution yet, is Custodia Bank. Custodia has spent years attempting to obtain a Federal Reserve master account. That fight predates even the FTX collapse. A master account gives a financial institution direct access to the Federal Reserve's payment infrastructure, the foundational plumbing of the United States financial system. Without it, any crypto-native financial institution has to route through a traditional bank as an intermediary. That limits what it can offer and creates dependency on the very institutions it might otherwise compete with. That fight may be heading to the Supreme Court. How it resolves will define what regulated crypto banking actually means in the United States. Here is what all of this adds up to. The Clarity Act began as a solution to a straightforward problem. The United States lacked a clear legal framework for digital assets. Builders were leaving, investors were uncertain. The bill proposed a clear answer. Define the assets, assign the oversight, give the industry a stable foundation. What followed was predictable. An industry with real exposure to competitive disruption organized and fought. Elizabeth Warren filed more than 40 amendments in opposition. The banking lobby spent millions in Washington. The fight focused almost entirely on the provision most threatening to their deposit base, stablecoin yield, and succeeded in restricting it. They still rejected the restricted version and pledged to keep fighting. Sam Lyman described the pattern in terms anyone can recognize. First, they laugh at you, then they ignore you, then they fight you, and then you win. The fighting is the signal. Industries do not organize sustained expensive campaigns against legislation that poses no real threat to their business. The banking lobby's persistence is evidence of the bill's significance, not its weakness. Phase 3 is the beginning of the end, not the end. And this is where the story becomes dangerous to dismiss. The bill now navigates two parallel obstacles: the Senate legislative calendar and the intercommittee reconciliation process. Staff are working to align the Banking Committee version with the Agriculture Committee text passed in January on a 12-to-11 party line vote. Some observers believe the bill could reach the floor before July 4th. Others have pointed to the August recess as the more realistic deadline. There are also observers who argue that enough political capital has been invested across this Congress that the bill would be difficult to let quietly expire, that the stakes are too high on both sides for it to simply disappear from the agenda. For anyone who has followed this story patiently, who understood that institutional participation was a question of when rather than whether, who held through uncertainty and through skepticism from people around them, the 15-9 Senate Banking Committee vote is a signal, not a conclusion. The Senate floor is still ahead. The two committee versions need reconciliation. The 60-vote threshold requires cooperation that is not yet confirmed. None of that changes the trajectory, it shapes the schedule. The infrastructure is already in place. The legal framework is closer than it has ever been. What do you think is the real reason JP Morgan is publicly opposing a bill while privately building on the same infrastructure? Drop your answer in the comments in a few words. I want to know what this audience concludes when they look at the full picture. If this video gave you a clearer picture of what is actually happening, go ahead and like it. Subscribe so you do not miss the next one. Share this with someone in your circle who is only following domestic crypto news and has no idea what is happening globally. Every institution currently fighting this bill in public is simultaneously preparing to operate inside the framework it would create. You do not spend millions lobbying against something that poses no real threat to your business. The persistence of the opposition is the evidence of the bill's significance, not its weakness. Stay informed. Stay positioned. I will see you in the next video.